Can you hear us, Dave?
I certainly can, Mark. Good afternoon to you, everybody.
Well, say good afternoon to Dave.
Maybe you can give him a round of applause and we'll start off.
Well, this is very odd. What is particularly odd is Dave's enormous face is there. And if I turn around to speak to you, you're only going to get the back of my head. So that's weird. But first things first, Dave, how are you feeling? You all right?
I'm feeling fine, thank you. I'm very sorry to not be able to join you today. I feel somewhat guilty, but that is the times we live in, unfortunately. So, yeah, I'm fine, thanks. I will be fine.
Good. Okay, well, look, let's kind of start. And you're in control, I think, of your kind of visuals. And as we talk away, rather than a sort of prepared speech, we'll chat away and kind of touch on the stuff that if you were pacing the stage here, that you would be doing. So I'll take us a wee bit back in time, because I've known you for quite a long time. I think I first met you 21 years ago, something like that. And that was before Nucleus was a thing, though I think it was a thing in your head and Philip's head, your co-founder at the time. And you were poncing about a life company that I worked for at the time. It doesn't exist anymore, called Scottish Life. And you were the only person in the building with a MacBook. And we thought, what kind of day rate are these jokers on that they can be having MacBooks? And we don't get that, because we were carrying around Dell laptops like this, right? That were pretty hard to do. But I thought it was interesting at the time, and that I met you and I met Philip, that I thought some of the things that would lead you to some of the, narrative, I suppose, when you started Nucleus. And I think you were having a rare old time, breaking tables and smashing up stuff in the temple when that business got going. And it was that funny thing where you're of the industry in the same way that I am, and I imagine many of us are here. I think you're very proud to be a failed actuary, you say sometimes, but that you were up for trying to do something a little bit different. Now, I think we'll get into maybe how different stuff could be and where it all went. But my sense was that you sort of wanted to change the dynamic from the inside rather than chucking rocks from outside it. Is that right? Or am I just kissing your ass there? Is that, what's your view on where you came from in that way?
So my sense is, that's all I think reasonable enough, Mark, and a fairly summary of where we were back in those days. I guess for me, the really big thing, we were of the industry, but I think we were also very much of the customer and of the advice market, although we happened to come from an institutional background. And, my particular interest was really around about, I guess, value for money and the truth and stuff like that, and to really check if we were delivering any. Most walks or most aspects of our life, we're able to make decisions because we're somewhat informed on the matter. We have an understanding of the product we're buying, or the holiday we're booking, or whatever it is. We work here in a very complex industry, which is hard to assess value for money. It's very hard to calibrate it. It's hard to measure it. We've heard earlier on today several people talk about a lack of data, coherence of data. I think even when we get to a pension dashboard, my money does not allow us to establish things like time-weighted rates of return and such like, in a very straightforward manner, from what I got from my 1989, Scottish Life EPP. So I think there's a real issue that we happen to operate in a space where this is just really, really difficult. And for me, when we talk about that sort of stuff, I was really interested in alignment and particularly long-term alignment, and how do we create a profession, a sector where we can be comfortable and confident, frankly, we're relaxed about being aligned in our customers' interests. And it's fine to, obviously, if people are successful at that and they make money out of it, then that's great. But actually, they've done it because they've done a good thing for customers, rather than they've managed to sort of exploit some kind of ignorance or information asymmetry, which massive issue here.
So a big part of our theme for today is the kind of journey that we've been on over the last 20 years, which obviously you've been a big part of, and Nucleus was part of when you founded that business. And it strikes me, I was writing about it the other day, and many of us that lived through it, we kind of take it as read that we know kind of where things were back at that time. But actually, there's a bunch of new people come into the industry. Not everybody is kind of old and knackered like me. There's lots of people who maybe didn't live through that. So take us back in time a little bit and talk a little bit more about what you saw at that time that you didn't like.
Yeah, sure. So I'll try and do the slides now. I'll just check this as yeah, I mean, if we go back to, probably roughly, Mark, when you and I would have met, I mean, I think you made the point this morning when we opened that an awful lot of good has occurred, we shouldn't overlook that. But the industry, and I think in those days it was very much, the industry was very actuarially controlled. It was a very product-led thing, and you didn't have to look terribly far to see negative headlines around about what was going on and how people were being treated. And I think that is just something that ran on for, really quite an uncomfortable period of time. And I remember, I guess I'm old enough to remember when disclosure first came in the early to mid 1990s, and people being outraged by the notion that we should disclose what we were being paid. It's just, prior to that, everyone just invested a certain amount of money, and the industry just extracted as much money from that as it possibly could until somebody found out about it. And, we talked a little bit earlier about the British Steel situation on pensions, which obviously was an outrage at every level. But I don't think that's anywhere near as prevalent now as it was back in those days. And I think, if you look at another slide here with other, there's loads of examples like that, which went on. And I think that's the kind of interesting part of it. I think if we start looking then, I don't know if we start talking about how pricing was back in 2006, maybe.
So I don't know if if people can hear me. So we've got a guitar signal chain, which I'm very excited about. By the way, you should tell people what's the theme of your slides, by the way, because not everybody may know your enthusiasms on a musical basis.
Apologies, and thanks to Ian actually. Thanks to Ian for the musical reference earlier. Actually, I chose LCD Sound System as the theme of my discussion today, which happens to be a band I'm quite into. And I think had I delivered this as a speech, I was going to make the point that if you don't know them, you probably should. And if your dinner parties will certainly improve if they end up with all my friends on the decks and you on the table. So that's what I was going to kick off with. So I'll overlook that point in this in this format. Sorry. If we go back to 2006, we look at how fees were, and we've got a few of these slides in this discussion, and it's worth saying, obviously, there are a vast range of variants on this, and all these numbers are kind of ballpark middle of the road for the time. So I know there are a million different versions of this, but for example, it wasn't unusual in 2006, and this is after, Ian Taylor started Transact, and you had the kind of fund supermarkets, which were actually largely remunerated by kickbacks from fund management groups, but nevertheless, you had that kind of model going. You began to see the sort of emerging heroes in the financial planning industry, but this is what it looked like back then. So you probably had, and maybe just to reflect, actually, bear in mind here, all we actually do is connect people to the stock market, right? Now, it happens to be through their ambitions and hopes and dreams, and hopefully considering their fears, but that's actually all we do in the end. And fees are something like this in those days. So that kind of advice fee of 80 basis points might have been typically 3% up front, or and 0.5% trail commissions it would have been in those days, or it might even have been 8% up front and nothing thereafter. So I've kind of just broadly split that across 10 years. We didn't really have the concept of a model portfolio service in those days. Platforms were actually about 75 basis points, which people find a surprising number. But if you go back and look at Integrafin or Transact's accounts, that's what they were charging in 2006 if you took into account all the little charges and everything that was going on there. And businesses like Scandia were most certainly capturing that amount, maybe 25 basis points headline rate, but there were kickbacks all over the place, and people were charging margins on cash and all that sort of stuff. And SIP providers' entire profit was the interest they were taking off cash rather than any actual real activity they were performing for people. And then asset management was probably around about 90 basis points. Yeah, that was kind of what the whole chain looked like. And we can argue all day about whether these were good numbers or bad numbers. Interestingly, there were hardly any passive funds being bought. I think it was about 6% in the market. And actually, interestingly, had a net outflow that year. So you had this kind of all this thing going on, and ultimately, and Mark made this point this morning, we had a reality. This is obviously long before RDR, and when a very, very small part of the industry was being paid by fees. The primary level of competition was often commission, which is a pretty astonishing thing to say now. So we have come a long way, but in that model, advisor remuneration was often the key driver of product selection and therefore of the customer outcome. And for those of you at the back or still living in 2006 or trying to take us back there, I just repeat that advisor remuneration was the key driver of product selection and therefore the customer outcome. And that, I think that's just a really uncomfortable thing. And then we had this kind of thing that changed when financial planning became a thing. Say Transact had launched and some of the wrap platforms came along, and they kind of removed that bias and that compromise that was effectively there, and we began to see the beginnings of people like Vanguard and Dimensional coming into the market, clients starting to play a little bit less overall, and frankly benefit from something that was simply better, and certainly their advisor or financial planner was for the first time economically aligned with them, which felt frankly like a massive step forward. And if you were to look at in those days, I say I use Transact as a standout example, and someone like Scandia or Funds Network on a web page in a browser, they would have looked pretty similar, I guess, but economically they were fundamentally different because, say, one was mostly being paid by fund groups to sell their stuff, and one was acting on behalf of advisors to try and make them more effective for their clients. And I think the other thing that was really interesting at that time is you had the FSA, a prior regulator, was acting very much in concert with the commercial drivers, and whether it was through the kind of pretty explosive CP121, which came up in your intro earlier this morning, or the more moderate RDR, the whole thing started to feel more customer-led, which I thought was a really, really good thing, and that took us through to 2020. Do you want to touch anything there?
Yeah, there's a couple of things that jump to mind, and one of them is a bit pointy-headed, right? But many of your not professional colleagues, because you're, as I mentioned earlier, very proud to be a failed actuary, but there might be some people in the actuarial profession saying, right, okay, we put an explicit value chain like this up, and it looks pretty expensive, right? If I'm adding, 165, we're at about 2.5% a year here. And that's a lot, right? That's, in this world, I don't know, I won't do a clear show of hands type thing here, but anybody that's got a total value chain to their customer in 2022 that looks like 2.5% is smoking something good. And that's probably how it should be. There is an argument that says, okay, but if you took old-fashioned products, the kind that I'm deeply uncomfortable about, and I suspect you were as well, but you took them over the lifetime of that plan, all other things being equal, and ignore consumer behavior and switching and all that other kind of stuff, actually the industry was taking less out. The total charge over a 30-year plan was actually less than this shit here. So is it the case that the kind of price went up, and did it need to do that before it could settle back down?
I think it's a fair point, but it's also quite a complex point because an awful lot of stuff wasn't being disclosed at all. The dear and very sadly late chair of Nucleus from its inception was a guy called wonderful man called Paul Bradshaw. Many of you will know, and we used to always joke that he should have called his house Initial Units because that's what paid for it. And there's the problem is that we didn't really know what was being paid before, frankly. These are just numbers that are, the best ones you can pull out. And there definitely was something about very, very long-term products having perhaps lower headline fees, but they also, a lot of them had things like policy fees that indexed by inflation that went up every month. And I think if you were to add all them up, you'd find a different sort of answer. It's interesting that when Standard Life demutualized in 2006, it demutualized at a valuation which was roughly 3% of its assets. As an insurance company, that number is sort of more or less held pretty firm for asset managers over the years. So I'm not sure it was that good a deal that was being offered. It just maybe felt like it was because some of the numbers weren't really disclosed. And obviously as well, it would have been quite common that you had no choice of the funds you'd be invested in. That was down to whoever the product development actuary was at the time.
I'll ask you something now that I think you've picked me up on before, and I know people get hacked off with us, or did when this was more, there was more going on in terms of pricing in the market, and Steve down here would have rocked the world with his heat maps, and now we sort of take that stuff as read and about price pressures and all that kind of thing. And in my head, I wanted to make today about outcomes, right? I wanted to think about who is benefiting from all the stuff that's been going on and where it goes. And shortly, I'm going to have to busk pulling this whole day together, and God only knows how I'm going to do that, right? But you could help me by telling me, in your mind, what weight does things like the total cost of ownership have? Or is the kind of smoothness of the journey more important than the absolute optimization of the destination by compression of value chain and that kind of stuff? Is that just a byproduct? Is it something that you were striving for? Is it something the industry has to strive for?
Well, I think, like most products we buy in our lives, we tend to be interested in the outcome. We just, because I got COVID, just cancelled our holiday. We were due to go on Saturday, and I was interested in having a good holiday to for the outcome of that rather than the flight and the hotel or whatever. And I think what this industry has tended to really badly is obsess about its own products and what they are rather than what the customer outcome is to be generated. And I think the wonderful thing that happened when financial planning emerged is it started to become that the actual real product the customer was buying was the outcome that they aspired from their life, or at least from the money and what outcome they could have for their life based on what money they had or they might have in the future. And that meant that from a customer's point of view, the product, frankly, is the outcome, and therefore everything else should be geared towards maximizing the likelihood of that outcome being achieved. And that means that fees do matter. Where we're dealing with complexity in people's lives, how efficiently we do it from a tax point of view, or a structuring point of view. When we think about all the complexity that exists in financial planning, that is an outcome-led thing, and you're trying to say optimize for the likelihood of the right answer. And I think it's really hard to do that if you don't have an understanding, or simply can't have an understanding of what's actually going on. You can't even model what outcome might be generated because it's just so opaque. And unfortunately, I say certainly back in 2006, I don't think you could sort of save as much as you could, and you could hope for the best investment return or something like that, but you couldn't possibly get under the skin of what was really going on and how it might actually impact your life down the track. So yeah, I think there's a massive piece in this for me, but the product and the outcome for the customer, I think, are pretty much the same thing. The industry will then obsess about its own products and how important everyone is in that, which often isn't really true, I don't think.
So you've worked with a lot of financial planners over the years, and I'm going to try and put words in planners' mouths, which is a very dangerous thing to do. So I'll give it a bash anyway, and you can shout at me later. Which is that the product is the planning, right? It's not all this crap up here. Or it's certainly not the bit from to the right of advice. It's planning, and we saw it in the advisor research that Steve put up near the start. The most important thing I do for my clients is give them a holistic view, is create proper financial plans, right, and do all that kind of stuff. I've got a concern, and I outlined it at the start, that the industry's hitting an inflection point where it might regress back to the stuff that we both knew so well back in the early 2000s and before that. And I started in my life as not my life. I didn't start as a direct salesman for Scottish Widows from the womb, right? But I was a direct salesman for Scottish Widows. widows were by no means, they were pretty good, I think, compared to many of the life cos that were out there. And I think of some of the with profits annuities and stuff that I did back then, and I'm probably not very proud of some of it. And I wonder if we are in danger of backsliding. And one of the reasons that I'm wondering that is, if the product is the planning, do you believe it's a case, because I think I do, that if nobody's watching the manufacturing side of the industry because their perception is that it is vanilla, that it's all basically fine because it's more transparent and all that stuff, that actually sneaky bastards will pop in and start trying to build unpleasant stuff? And it's when you don't look because you think it's fine, that's when little decisions that could go 50-50, that don't seem big themselves, they go the way of those that take rather than those that give, and those that give are the client who's giving their money to this industry to look after. Am I smoking dope on that, or is there something in it?
Well, I think most companies that are successful do so in most industries, I think, by having some regard for what the customer wants to do. So it feels to me the person closest to the customer is the person who's best informed on what should happen here. The problem is, I think, in this world, it's very everything else is very complex. Everyone involved effectively in fulfilling that plan, everyone in the supply chain of that plan, it tends to invariably, frankly, to be better capitalized than the advice firms and have more control they can exercise through that over time. So I think the wonderful thing, say, when Ian and Mike and the guys set up Transact, and what we tried to do at Nucleus and others, Hugo did at Eccentric or whatever, was saying, well, actually, we very happy to say we're in your supply chain. We understand that we work for you, right, in trying to make this plan have the greatest chance of being executed successfully, right? I think when you get to a situation where the motivation is to sell a product because that's what we do, we are an asset management business, and we think that our funds should be a big part of this customer's journey over the next 20 or 30 years. Well, frankly, a lot of the time you don't even know who the customer is. How can you possibly make that claim? So I wonder about where it's essentially where power sits, and in most parts of society, it has become accepted the customer has a lot of power. And in this case, I think the sort of advisor customer as a kind of cluster, with the advisor making the customer informed, should be where the power sits. But that isn't really the case always in an economic sense in this space. And there's so many kind of crazy examples. We could, and I've got a few here which maybe just reel off. I mean, I saw a discussion the other day on Twitter. Somebody was chatting about some Standard Life tracker fund that invests primarily in a Vanguard tracker fund, but charges 16 times the price. And I have no reason to believe that's untrue. And a way for that not to happen would be, and that is the business model, obviously, of certain vertical integrated businesses. We just mark up something you can buy at wholesale much cheaper. Now, I think what's interesting in that example, and I'm sure I don't mean to actually pick on Standard Life, there's probably a million other examples. Why don't they just charge for the wrapper for what they do, and then we all know what they charge for the wrapper or the platform, whatever it is in that case, and provide access to the in that case the Vanguard fund, kind of really clearly and a fair the true price. And I think we know the reason for that. And it's interesting to listen to Sheila a little while ago talking about the cost and implying regulation and everything. I mean, our biggest listed asset manager has got average remuneration per employee of £150,000 a year. That, and it's more than 100 grand a year pretty much everywhere else in asset management sector. And does that fairly reflect the utility value of that sector to society, or is that just because we can do that and it's worked forever and we can keep on doing it? I worry about that sort of stuff, and where platforms have got economic alignment with advisors. Some have been acquired by fund managers with a totally different agenda, and that might be to sell really expensive funds to people that don't really know what's going on, and that sort of stuff takes me to I guess share your concern about regression and going maybe full circle. And another one which I think is really, really dark actually is where there's where advisors and planners do an amazing job for maybe 20 or 30 years, and then they reach the end of their own careers, and someone's waiting there trying to essentially exploit the conflict, sort of end a career conflict between advisors and their clients. And they buy up the exiting firm, say it's going to be fine, and then over time churn everything into in-house funds and an in-house DFM and in-house platform. And we don't seem to have a world here, for whatever reason, that vertical integration at that level is generating efficiency gains. It seems to be, quite the opposite. And I think there's a kind of example in the market that we're probably all familiar with, that people are paying 8% of assets to buy advisor firms, and you just run some pretty straightforward maths on that, and that says we've got to make 100 basis points profit on this client forever per annum. I'm not sure that's. I mean, if you talk about consumer duty, I think it's really hard to align the consumer duty with that model. And I wonder whether the people that are buying into the sector, and maybe in some of the advice consolidation businesses and such like, are really understanding the pressure that might come on that. And it's not to say that fees are the only consideration, but if the probability of the outcome being optimized is the goal, and fees are too high, then that will be less likely to happen. And again, if the consumer duty is really about saying, well, if only you knew what I knew, you'd do something different, then I'm pretty sure that would struggle to stand scrutiny, I think.
We had a question in from Henry, who is streaming. Hello, Henry, if that's your real name. I have no reason to disbelieve that is actually Henry's real name. He's certainly registered under it. And that's good enough for us. But he asks something along those lines, and I will do a little bit of this, and then I want to ask you, I don't know if you'll think it's challenging or not, but I'm going to ask it anyway. He's asking, is PE consolidation in the sector a good thing or a bad thing? So we've got new kinds of money coming in here. This sector got really exciting. We'll spin the value chain forward, Dave, so that we're looking at something a little bit more recent. There we are, there's 2020. So let's talk in the context of this. But before we do that, so keep that one in your mind. I'm doing a Claire trick here of putting one thing together. She was very good at doing that. You talked about economic alignment and the alignment of platforms with fund managers in the vertical integration world. And I guess for the consolidation aspect of the advisory market, the same kind of stuff. Now, you did some of that as well back in 2006. Where there was an ownership model for Nucleus, which at least partially was for firms. And I guess the challenge of that was around, God knows when I was competing against you back then, I banged on about conflicts of interest and all that kind of stuff there. Made not blind bloody bit of difference, frankly. But I gave it a good bash. How did you square that away? Because there was an alignment there, and viewed from one lens, it's great, but there is another lens that you can view that stuff through.
Yeah, definitely. Yeah. So, I mean, in that particular example, if I address that first, the advisor firms that had equity in Nucleus paid the same price for it as anyone else did, myself or Sanlam or anyone else included. So it's probably important to make that point. It wasn't some discounted or free equity for a start. The other thing we managed to do, as I say, at that time, the price in the platform market, if you cut through all the noise and all the lies, was about 75 basis points. And we managed to launch at 35, which at the time was a big step change on a fully transparent, disclosed basis. And we were able to do that because people were aligned with us through partially being owners in the business. And it was very clear that if we were ever not competitive on that model, then people wouldn't use us despite their shareholding. So I was always very relaxed about that because we'd managed to kind of redefine the price point in the wrap space at the time. I think on the wider question about PE or being a listed company or being privately owned or family owned or whatever, I don't think the capital itself is going to be the problem. There's lots of great businesses owned in any of those ways. There's lots of great businesses that are crowdfunded, PE owned, VC backed, whatever. I think it's actually cutting through the intention and the motivation of either the management team or the capital provider, and hoping and doing what you can to demonstrate alignment of long-term interest. And I think that's the key to it. I mean, someone mentioned earlier on, there was a discussion I think about Vanguard, and Vanguard is a mutual, and I think it's pretty clear on how it views the world. Equally, we've had mutuals in other parts of either banking or life assurance where they haven't necessarily thrived because there's been kind of governance failures or whatever it might have been. So no more. I don't think you can point on on a form of capital that is, in any way guaranteed to be the right one or indeed the wrong one, and certainly not over a very long period of time. Because one of the things that I find really difficult with this area is we're tending to, um, you know, try and find customers or support customers for 30, 40, 50, 60 year period of time. And hell of a lot changes in that sort of period of time, and it's frankly unlikely that any one company is suitable for anybody for that, for the duration of their financial plan.
Okay. So we've got the 2020 value chain up here. So let's talk a little bit about where we are now. And do you agree with my assertion from this morning that outcomes at the moment, based pretty much on this, actually, this has kind of been the last couple of years, I guess, kind of pandemics aside, that this is a good time. This is a kind of golden time in terms of outcomes, that there's a lot of good stuff in here, and that the danger point isn't necessarily this, it's sliding away from this to something else? Or am I overly optimistic with what I think I've seen in the last few years?
Yeah, look, I think it's a better time than where we came from, for sure. Just actually, maybe for everyone's benefit, hopefully these numbers are pretty clear. The one that people might raise an eyebrow at might be the 5 basis points for the model portfolio service. That this is a kind of weighted average across the entire sector, and it represents an average of about 20 basis points, but only about 25% of the assets being invested in that. So it's sort of like a quarter of that. So yeah, I think this is definitely represents progress, but it, if you actually look at the operating model, it's not that different to what started 15, 20 years ago, really. And you're starting to see there's a risk, as you've hinted a couple of times earlier today, of us kind of regressing away from this. And if you can take control of the advice piece, and then kind of shovel more asset management or platform through that, or NPS through that, and the risk is this improvement stalls. And I think if you look at pricing alone, which is by no means the only measure, then we haven't really made that much progress on this in the last 2 or 3 years, I don't think. And what's interesting, earlier actually listening, I think it's Claire mentioned that ESG was just about green shit or something, and I just don't buy that. I'm afraid. I think there's something much more important about how companies are run and what they stand for and who they are, which I think falls very much into the ESG bucket. And I think if you look at pricing and values, if you like, and intention, that's what I'd be kind of thinking of. But yeah, I think there's a long way to go on this now. And what's interesting for me is whether this 2020 shape is kind of what we're left with. And frankly, even if we got left with this, that would be, to me, a net regression, because there's an opportunity to go much further than this. I think over the coming years. Now we got kind of better technology, more modern, more access to data, better understanding of what can be possible in terms of running clients' affairs.
That's really interesting, and it's absolutely crucial, I think, because if you believe that, first of all, I haven't heard you say before that even this situation is a net regression. That's a really interesting point. But what are the particular danger points if we buy this narrative that I set out so imperfectly this morning? I was shocked and saddened and disappointed with how I did that. It's going to run a run, right? That I've got my views on what the kind of danger points are, but I wonder what danger points you see. If we are going to backslide, where will it come? Where will we see it?
Well, I think the obvious place is where the control is lost. I mean, financial planners, I think the reason we made this progress is because financial planners put themselves very firmly on the customer side of the table and helped drive that change. When we went from effectively the sort of fund supermarket model to the wrap model, and that empowered advisors enormously to, for example, start using. Well, we actually knew what stuff cost, which is a pretty big deal when you think about value for money. You've got to know what the cost is to even begin to form a view. It also allowed us to start to use things like index funds in a way that just was never possible, but had been pretty big even then in the institutional market. So, a data point that just freaks me out is that retail asset management consistently costs about 4 times that of institutional. And I get that there's smaller clients and there's kind of probably a bit more friction dealing with retail clients, but I can't see any justification on earth for it being 4 times the price. And all that stuff started to, kind of break down. So I think we're in a position now where we've gone through the, whatever fund supermarkets into wrap platforms, created this space for advisors to do their work sort of somewhat unconstrained by what I'd call product provider interest. But if half the platforms or advice firms all get bought up by providers again, it's only imagine that the intention of that is to kind of get back to a position where we were maybe 20 years ago, And I think if you look at it from a advisor's point of view, I think Anthony made the point earlier about LOAs and just making life straightforward. There's so much complexity around about system connectivity is generally a disaster. Promotes inefficiency across the board at the moment. There's no kind of seamless digital engagement whatsoever. And actually, I think also really importantly, and maybe this has been the one substantial failure of the RDR, is that a substantial proportion of the population has effectively been excluded because it's been we've ended up with this kind of supply-demand issue for quality financial advice. And I think if all these things are problems, if you like, that need to be addressed if we're not to go backwards.
You were a guy in certainly the early days of Nucleus, and then through that explosive growth period for platforms, around 12, 13, that kind of time, who was very, very vocal about the sins of the past and what you were trying to do, and other people joined that narrative as well, and you either had fun with it or you didn't, right? Looking back over that time, is there stuff that you wish you'd gone harder at? Was your aim true, or are there things that you missed out, or did you spend too long pushing at one particular Aunt Sally, or how do you feel the level of disruption that you wanted to see has played out over that time?
Well, yeah, it's never one never achieves enough, right? It's always frustrating, and it never quite it gets to where you want it to get to. So I think when I left Nucleus a few months ago, the thing I wasn't terribly proud of building a business of that size or whatever. It was the thing we never compromised on was our belief system and our values, and we held that true all the way through. And that was the only thing I was really proud about. So whether we didn't disrupt enough or have a big enough reach, I think is probably a very fair challenge. But we were still proud of what we had done, I suppose. And I think actually, if you were to if Ian were sitting here as well, they did a massive role in that as well as Hugo and Bill and all these guys. So I think we did it right, maybe, I don't know, but we just tried to tell the truth. It's one of these kind of really weird things that in our personal lives we form our relationships based on generally, I don't know, respect or truth or whatever it is. And for whatever reason, in a lot of financial services, where there's an opportunity to make some money by not doing that, some people like to jump on that, and I think that's an uncomfortable reality. There's been a conference, it used to be called the Future of Life and Pensions, that was run by Westminster and City, I think it was called, and I think it became something about the future of platforms at one point in time. I think for the last 20 years, the keynote speech in that is we're going to start putting the customer center stage. I mean, it's literally been the same in some. The next random life company CEO has done it one year, and another one the next year, and another one year after that. And it's like, well, why don't you just do it? Now we don't have to have this talk every year, because now isn't the time. The time was 20 years ago, not now. And I just don't get why that can't be more possible. And I really hope, actually, I've got really high hopes for the consumer duty stuff, that we actually start to put some real accountability onto management and shareholders, frankly, to do the right thing, because it's to me it's just why wouldn't you do that?
So that's a good time, I think, to start looking for a positive future. So we've talked a little bit about the risks of backsliding and regression and that stuff. So let's look forward a little bit. So for us to keep on a beneficial trajectory as opposed to a negative kind of regression trajectory, what do we need to do, and what's going to hold us back?
Yeah, so I think it's actually really exciting. I guess we've spent a big chunk of this looking backwards. I mean, excuse me. I'm a great believer in sort of first principles reasoning, and I told a story a couple of years ago at a Nucleus event, so apologies if anyone in the room has heard this before or read it, but whatever you think of Elon Musk, the framework for thinking on first principles, I think, is extremely sound, and you know, generally we can boil things down to their fundamental truths and reason up from there, as opposed to reasoning by analogy. And I think what that does, instead of reasoning by analogy, which you essentially copy what other people do and get a little bit better, you actually think very differently and say, well, what might be possible? And I think the example that I remember reading about Elon Musk was to do with the cost of battery packs, because he was obviously thinking about doing electric cars. And historically, they were costing $600 per kilowatt hour, and nobody could see why it was going to be much better than that in the future. And Musk's train of thought from first principles point of view is, okay, what is the market cost of the material constituents of batteries? Essentially, what do cobalt, nickel, aluminium, carbon, and a steel can cost on the London Metal Exchange? And it turned out the answer to that question was about $80 per kilowatt hour. And then the job then was just to think of clever ways to assemble those materials and combine them into a battery cell, and then you can have batteries that are much cheaper than anyone had imagined. And I don't think enough of that sort of thinking really goes on here. We've talked before forever about almost like cartel-like pricing on fund management, for example. And to get these step changes, I think you've almost got to go back to, well, what is imaginable here? What could happen if we actually just didn't do the iterative thing and kind of ripped it apart? And I think it's really interesting, actually, if you look at the massive tech giants that touch our lives. So, if you take Google, Apple, Amazon, Facebook, Microsoft or something, these companies tend to make profit. Enormous companies, enormous success, huge scale, and they make annual profits typically 20 to 30% per annum, which is a very big number, but it's actually lower than our retail asset managers and our leading platforms. It's about the same as our kind of legacy wealth managers, where, by the way, you can still pay 2.5% per annum if you want to go there. So I think we've got this kind of weird thing where we've got relatively subscale, certainly compared to those tech giants, businesses that are making much bigger profits, presumably because they can, rather than because they've actually gone away and found a materially much better way to do this. And I think so if we start thinking about the first principles way of looking at the problem, I think you get quite a different answer, Mark.
So I know you've got a version of what that future might look like, so why don't you stick that up for us?
Yeah, okay, let me see.
Oh, well, that's what we were just talking about there. We'll talk to that just for a second about, these are kind of three fundamental parts of that bit that you were just mentioning there.
Yeah, and I think we probably touched on it. I mean, it's, why should we shy from the truth? What is so embarrassing about just telling it like it is, good and bad? Frankly, that feels to me to be a sort of pretty basic behaviour. But if you then look into, say, fund management, for example, and again, maybe going back to your earlier principle about, kind of outcome based. A portfolio might consist of a bunch of funds. And we might all be pretty familiar with the cost of passive and active funds, retail. Again, if we look at them institutionally, it's quite a different thing. But if we think of the outcome generated, that is essentially a combination of beta, maybe some factors, and some alpha. And if you start with institutional pricing as a proxy from my London Metal Exchange Elon Musk story, you can buy those three outcomes for. You can probably buy beta for less than 10 basis points. You can buy factors for less than 20 probably, and pure alpha even less than 40 institutionally. And if you had 40, 40, 20 split across them, the overall cost would be less than 20 basis points. So we know we can make it for 20 bips and have an outcome which is commensurate with what we're getting today. But that's at a price which is less than 1/3 of what clients are paying today, and that feels uncomfortable to me. And even if you include transaction costs and a 20% profit margin, you start to talk 30 to 35 basis points for retail asset management, which is less than half what people are paying today. And that, I don't think that feels like an unachievable thing to do. But yet, obviously, not everybody's motivated to do so. And I think actually, in a consumer duty world, whether you're a financial planner, frankly, or whether you're an asset management business, as these things become understood, and they're certainly understood in a retail asset management business, I'm not sure you can keep on justifying charging twice that. That feels to me to be a bit of a stretch. And again, if you look in the platform space, you've got a prevailing pricing is probably north of 20 basis points, but marginal costs obviously much lower because there's a bit of there can be a scale benefit in this if you've got a scalable business model. Again, I'll refer to Integrafin as probably the sector leader. Yeah, I think if you look at their accounts the last few years, it looks like their marginal cost of manufacture now is about somewhere between 5 and 7 basis points, something of that order, depending on, again, how scalable all that is. And I think that gives you an indication of where the price should be trending toward, and it's not going to go as low as that because there's some cost in the business before you get to that point. But if people have got a tech stack that truly scales and can deliver something fully digital to the market, I don't see why that can't become a 12 to 15 basis point market in the not terribly distant future. Call it 15 maybe. I think what's quite interesting, and you look in as things get more digital, if you analogize from a sort of fund supermarkets to wrap platforms, which tend to be somewhat analog, somewhat digital, into a purely digital future, the interesting thing then becomes, well, the technology is now a bigger part of this whole thing. What is the role of the corporate in that whole kind of structure? How much is it consuming against what's being consumed by the cost of the technology? So, it'd be interesting to see whether that becomes somewhat disintermediated over time. And then on the model portfolio side, we started at this place, obviously, classically was 30 basis points.
Change the slide, Dave. Change the slide, Dave.
Oh, sorry, excuse me.
Yay! There we go. Now people can see, I think, where you're going with it.
Sorry. And Tatton probably brought us down to 15 basis points, but we're still 20 to 30 in most cases. And again, if we're talking about value for money and we're talking about knowing what we know, the institutional space, things like asset allocation and fund selection, probably massively scalable activity, probably cost less than 5 basis points institutionally. You got to obviously get retail activity to sell the thing and regulatory and operational risk and that sort of stuff. But again, it feels to me, compared to the last chart, this will actually go up as an overall weighted average, but that will be because the penetration of the market rises dramatically. So we might actually be sitting at two-thirds of the market uses service, and the price is maybe 15 basis points, something like that. And then what's quite interesting, I think, on the advice one is it's much harder, right? Because it's the least scalable activity by miles. It's the one which has got the most human element, and it's the one actually which makes it much harder to apply first principles thinking. But if you look at it, if you can imagine a world, right, which I know this is probably a stretch for the advisors in the room, but if you imagine a world where you don't have to deal with legacy providers anymore, you don't have poor system connectivity, you don't have even old school views on what it means to be compliant. I think if legacy providers have a diminishing role and frankly get fined by advisors for their underperformance and incompetence. I had a debate with a guy last week on Twitter where he's sort of saying, what should I do? I think it was Aegon. He was saying that I can't get through to them. I'm on the phone forever, but it's cheap. I said, well, it isn't really cheap because your time is valuable too. And actually what's happening here is you're stomaching the cost. And meanwhile, some Aegon's not employing enough people to answer the telephone or whatever it was. So I think if you can imagine, and also I think on compliance where Rory Percival would have also had a go at this, there's been this massive focus on arse covering rather than just doing the right thing. And I think the consumer duty is taking us very clearly into a place where, just be confident you're doing the right thing and be comfortable you can demonstrate it rather than sending people, kind of hundreds of pages of junk. I think over time we can maybe boost advisor capacity 2 or 3 times over. And if we can do that, maybe we can have a world where you can sort of double the size of a financial planning business, but only add on 50% of the cost. And that would actually allow fees probably to fall by around 25%. So I can easily imagine a world which looks a bit more like this. And then you say, well, okay, what's that? I'm trying to add these numbers up now. That's 120 basis points, right? So again, if you then talk about Vanguard, and someone mentioned earlier, who are at 80 basis points for a narrow proposition, particularly focused on certain types of people, and obviously certain limitations on what the types of advice they'll give or the scope of the advice they'll give. It doesn't feel ridiculous as a markup for a kind of fully premium service that covers everybody's scenario and people with more complex affairs. Whereas today's price of 180 basis points, which is obviously way more than double, it starts to feel a bit uncomfortable to me. So, I think that's the sort of stuff we need to be, kind of starting to think about. It's probably a slightly purist or aspirational view of the world, but I think it's, it should be possible. But it will only be possible if advisors regain control of the situation. And say, like, the customer outcome here, I think, is the most important thing by far. That's what we're actually here to do, and we're not going to be blown off track by the interests of other parties. And I think if the financial planning community can actually kind of really re-establish the ownership of that space, then all this is entirely feasible.
Okay, brilliant. I think we could kill the slides and go to full screen on Dave now. Are you okay to take some questions, Dave?
Yeah, for sure. Yeah.
Yeah. I've got one or two in from speakers here, and a couple of kind of manufacturing based, right? But we'll ask them, and I get a sense of optimism from you, right? Which is not bad for a guy that just had to cancel his holiday. But Michael asks, are platforms spending enough to evolve their tech? We still live in a monolithic, batch-driven world, and yet we want to talk about APIs and data sharing when the core tech appears to be inaccessible despite, oh my goodness, hang on, despite aggregators or enterprise orchestrators. Well, first of all, Michael, thank you. Mr. Thesaurus there, and Dave, A, do you know what that means? And B, do you have a sense of whether the platform sector is doing the right thing, is spending enough to improve things the way which you've talked?
Yeah, so it's obviously hard for me to speak for every firm. I quite enjoyed Anthony's sales pitch from my new employer earlier on. We talked about some API first model where everything's available and can be connected. I do think there's an issue where some of the platforms in the space are somewhat analog in nature. I know when I was at Nucleus, we had an issue where we were the only platform, I think, that of any scale that could provide a fully universal transactional API out to people wishing to do analysis on that. So that felt to me like a pretty fundamental thing, and nobody else, I think, could do it. So you're never going to get this connectivity and this efficient market until that all happens. And I think, again, Anthony made a really good point as well about the transfers visibility. A reasonable number of inbound inquiries into platforms, I suspect, are chasing down transfers and saying, where is this thing that was sent off a few days ago or a few weeks ago? And actually just putting that on the platform is not that big a job, but hasn't been done in most cases, and therefore those inquiries come in, and you end up with this kind of analog business. You've got too many people in the customer service team, whatever, and queries get downstream problems from that. So I think I couldn't comment on individual firms, but there's definitely seems to be a thing in the platform market where, possibly led by Hargreaves Lansdown's great success, where it's just become accepted that if you're not making a 50% profit margin, you're not at the races. And maybe instead of making 50% profit margin, it'd be better to make 40% or 30% and invest a bit more as you go.
Okay, that's really good. Do we have any questions from the room for Dave? Yeah, we've got one over here, Rich, if you would be good enough. Pop your hand back up, sir. Thank you very much. Go for it.
Hi, Dave.
Oh, hang on. Hang on, try again. Do you want to shout it and then I'll say it back to Dave?
Yeah, sure. I totally agree with Dave that financial planning firms actually have the commercial power now. But who in the industry is an ally of financial planning firms, and who are the enemies of financial planning firms going forward in the next 10 years?
What a great question. You wouldn't have heard that, Dave, but the gentleman asks, well, he says, first of all, he believes you, and that's a good start, that the power is with financial planning firms. I mean, really, you don't want to believe too much of what this guy says. But who is the ally of financial planning firms, and who are the antagonists of financial planning firms as we look forward?
This is probably not an exercise in promoting anybody in particular. I think it's been pretty evident over the years, to be honest. I think everybody knew what Transact stood for, what Nucleus stood for, and other businesses like that. They were very much on the side of financial planning and sort of rejected the prior model. You can see it run through, I think, the way companies conduct themselves. You can see it in the way they think about pricing. It's there's enormous information asymmetry in this market, but there's also enormous aggregation asymmetry. And I always struggle with if you look at things like pricing models, where a firm will say, yeah, we charge X, that's our headline price, and we also charge this if you do drawdown, you do this if you take an income payment, need a statement, if you we take a margin on cash, all that sort of stuff. No one adds up those little things at the client level because it doesn't sort of matter, because it's only 20 quid, it's only 50 quid there. But actually, the aggregation asymmetry is that the corporate makes a load of money out of that stuff. So it was very much true back in the day, where more than the aggregate profits of the SIP market came from dirty margins on cash. Right? You go to Novia in 2019, the money they made on interest on cash was more than half their profit. Right? And I'm not saying that's necessarily a bad thing, but I suspect that's not terribly clear when they promote the price and the proposition, right? And all that's doing is creating an awkwardness somewhere for financial planners down the track when someone works this out and says, instead of paying whatever it was, I don't know, 30 basis points for a platform, I'm actually paying 36, or whatever the numbers are. And I think there's an honesty and a truth in financial planning that is strongly echoed in some of the providers or technology providers or asset managers, whoever who support them. And then there are others for whom that truth doesn't run, that line doesn't run quite so true. And so if you're looking for allies or trying to think who are allies here, I think it's got to be people that are highly aligned on values, highly aligned on maybe just recognizing I'm actually in your supply chain, right? I work for you, and if I'm going to make a change to my business, I think one of the platforms that was bought last year changed their pricing for some of the model portfolios or something recently. If you're a financial planner and your customers are using those pieces of functionality, your price has just gone up, right? That's what's happened. And are you happy with that? Were you consulted on it? Did anyone care that you were bothered about it? All that sort of stuff, which is again, pretty fundamental, I think.
Okay, I'm worth saying. I imagine if Bill Vasiliev was here, he'd be chucking stuff at your screen right now.
I had beers on a curry with Bill a couple of weeks ago. I'm very happy I could afford to pay.
Okay, any more questions from the floor in here? And indeed from streaming, I've got one more streaming question to ask here. Oh, we got one down the front here.
Thanks a lot. Based on your 2025 value chain, asset managers charging 35 basis points, advice 60. Presumably this is a big incentive for asset managers to think that's the part of the value chain that I'd like to be gobbling up. It's more vertical integration headed?
Yeah, it's an incentive at one level, but there's also a thing about what you're capable at, right? I would love to win the 100 meters in the next Olympics, but it's simply not going to happen. So I'm not even going to embark upon it. It's been quite interesting, actually. You've seen over the last 10 years, asset managers who maybe been good or bad at what they do, whatever, suddenly think they're possibly capable as wealth managers as well. And it's not necessarily true that works. And I think when businesses try and stretch into something that they have no good reason to be good at, it can work, obviously, and a lot of times it won't. And I think if they're doing it just to, because I think the real point in that question is that the reason why financial planning should command a higher price is because it's not a scalable activity, right? It doesn't mean it's twice as profitable or anything like that. It just means it's got a higher price because it's an individual activity that you have to do on typically a one-to-one kind of basis. So people might be attracted by the revenue, but obviously if they've got a cost base that sits behind it, it might not actually be any more worth their while doing than what they were doing before.
Brilliant. Well, look, I think we're going to have to call it there, Dave. And you happen to have answered the last question pretty much that I had on my speaker pack as well. extraordinary effort for a bloke that should probably be in a scratcher at this particular time. So I don't know if you'll hear it or not, but I think Dave deserves a proper round of applause for that. Thank you very much.
The next.
Right, can we get rid of this guy now?